I have something very interesting to talk to you about. I have the top 10 tax advantaged investments everybody needs to consider. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as splendid as I am, go grab a cup of coffee or tea or vodka and let's roll. Today's conversation will be fun, but very interesting. Because paying taxes is no fun, right? And I will talk to you about the top 10 tax advantaged investments everybody needs to consider. The good thing is that there are many tax-free investment options available, each with their own unique set of benefits. So choosing the right investment strategy depends on what? Your specific goals, your values, and finances. So in today's show, we're going to look at the top tax-free and tax-deferred investments that let you keep the money you earn. Before we get into the nitty-gritty, what is a tax advantage account? Let's just break it down. This is a kind of savings plan or a financial account that provides you with a tax benefit such as tax deferral or tax exemption. So tax advantage accounts are popular for retirement savings, education expense savings, and savings for healthcare expenses. And examples of investments within a tax advantaged account include stocks, actively managed funds, high yield bonds, REITs, and annuities. And tax advantage accounts come in two forms. So you have pre-tax, also called tax-deferred investment accounts. So tax-deferred accounts defer your tax payments on contributed amounts until a later date. So this is usually many years into the future, 20, 40 years, delaying any taxes due on investment gains until funds are eventually withdrawn. That's the first category. And then you have after-tax investment accounts. So these tax advantage accounts are funded with contributions you've already paid taxes on. So the advantage comes from not having to pay taxes on any of your investment earnings. So each type of tax advantage account has different retirement savings options, like employer-sponsored defined contribution plans or individual retirement arrangements. So it really depends on you. Now, one thing you have to understand though, all of these accounts have rules to follow, such as contribution limits, timing of withdrawals, participation eligibility, and so on and so forth. There are also tax advantage investment accounts available for education, childcare expenses, healthcare savings. Right now, you want to make sure that you choose the right strategy. You need to max out tax advantage accounts to pay fewer taxes, because taxes will not and should not be your only consideration when determining where and when to save and invest your money. But it is very clear that using tax advantage accounts is beneficial and it is legal. All right. So by maxing them out whenever and whatever possible, you can keep more money in your pocket. So let's now talk about how to decide what's best for you. First, you need to determine your eligibility for and access to the various tax advantage accounts that I've just talked about. So you need to consider the following questions. Does your employer offer both a traditional and a Roth 401k, 403b, or 457 plan? And in case you're married, what type of 401k, 403b, 457 plan does your spouse's employer offer? This is very important. Does your or your spouse's employer contribute to your retirement savings plan? If yes, is it a matching contribution requiring you to contribute a specific percentage? Another question you want to ask yourself is, will your annual income disqualify you from investing in a Roth IRA? Because if yes, you want to figure out whether you could defer some income into a traditional 401k plan to reduce it enough to Roth IRA eligibility. Do you hold a high deductible health insurance plan allowing you to use a health savings account, HSA? Is a health or dependent care FSA available to you through your or your spouse's employer? Is it essential for you to provide for some of or all of your children's college education? So once you consider those questions, you want to order the funding of them based on your income, your current and expected future tax brackets, your savings goals and priorities, including emergency funds savings goals. You need to look at the time horizons for each target, because you have to really remember though that each tax advantage account will have contribution limits, investment options, ease of use, and potential tax savings. Your decision to invest pre or post tax will come down to individual values and when you feel it's best to pay taxes on your income. This is something you have to decide on your own or with your spouse. Because come to think of it, it is great to receive tax savings today, but the benefit of receiving tax-free or tax-exempt retirement income in the future is something that you cannot overlook. Generally, and this really, in research has shown this, low-income earners will want to focus on putting their money in post-tax accounts, Roths, while high-income earners will want to defer taxes by contributing pre-tax. So a combination of pre-tax and after-tax investing will create a tax diversification strategy that is beneficial for most. With uncertainty about future tax brackets and where you'll find yourself down the road, diversifying your investments between various tax advantage accounts is a strategy worth considering. So the thing here is that maximizing contributions to both types of tax advantage accounts now provides you with the flexibility later in terms of managing where you will draw your retirement income from and the resulting taxes, if any, you'll pay on those withdrawals. So this is something you have to think about. Okay, now let's just delve right into it. What are the top 10 tax advantage investments everybody needs to consider? Number 1, 401k/403b employer-sponsored retirement plan. So employer-sponsored retirement plans offer great ways to invest for long-term periods, right? It's very easy. The law makes it very easy because your pre-tax contributions are deducted from your paycheck, and this process lowers your AGI, your adjusted gross income. So many companies will match your contributions up to a set amount and may even offer profit-sharing plans, so the earnings accrue tax deferred and can be withdrawn after retirement when you are in a lower tax bracket, hopefully. There are limited contribution amounts and penalties for withdrawing funds early. So you might also want to consider a Roth 401k, which uses after-tax money for contributions, but offers tax-free growth and tax-free withdrawals in retirement. So although contribution limits are spread between a 401k and Roth 401k, you can contribute to both if you want it. A diversified retirement portfolio will provide you with more withdrawal options and benefits. The thing here is that employees of nonprofit companies may have access to a 403b retirement plan instead of a 401k, but both use pre-tax dollar and grow tax deferred, however, right? So this is something you need to think about. And one thing I also want to remember is that the nonprofit employer may not offer matching contributions because, again, they're a nonprofit. And generally, a 403b has lower administration costs associated as well. So number 1, 401k, 403b. Number 2, traditional IRA or Roth IRA. So an individual retirement account should also be considered for tax-conscious investors because these plans offer tax-free growth. Both traditional and Roth IRAs allow annual contributions up to $5,500 under age 50 and $6,500 on over age 50. However, income limits and company retirement plans can impact eligibility and the deductions available. High income earners can still utilize the benefits of these options with a little more work. So the thing here is that traditional IRAs would allow pre-tax money to be invested tax-free and withdrawn in a lower tax rate at retirement. However, traditional IRAs also come with drawbacks such as mandatory disbursement after a certain age and other issues. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm still talking to you about the top 10 tax advantage investments everybody needs to consider. Number 3, we have the health savings account, HSA. So you can use an HSA to invest in a tax-deferred and tax-free earnings on eligible spending. So in addition to decreased medical costs for upfront spending and saving for medical expenses, an HSA offers tax benefits as well. Why? Number 1, pre-tax contribution can be tax deductible. Number 2, interest earned is tax deferred. So the money will grow until it is used and does not expire. So when utilizing an HSA for eligible medical expenses, withdrawals can be tax-free. You can also consider additional HSA accounts for family members or a family HSA plan, but you have to be mindful of annual contribution limits. Another thing you need to be mindful of is that HSA accounts are limited to high deductible insurance plan holders. So current healthcare spending trends seem to favor high deductible plans. So insurance companies and employers are also keen to pass on more costs to plan holders in order to ensure responsible healthcare spending. So investing in an HSA account offers many tax and healthcare spending advantages, making high deductible healthcare plans more attractive, especially if your employer offers matching contribution. Number 4, munis, municipal bonds. A muni is issued by a state, city, or county to finance spending, and since these bonds are backed by government entities, they are generally safer, but typically offer a lower return, right? So the lower the risk, the lower the return. Municipal bonds are sometimes called triple tax-free bonds because some are exempt from federal, state, and city taxes, depending on where you live. But having said that, not every muni is exempt from taxes, so you really need to consider your options carefully. In other cases, investing in municipal bonds may cause the alternative minimum tax, the AMT, to apply, which can greatly impact your taxes. So when considering investing in a bond, carefully research the returns and taxes associated to determine if the investment will be worth your time. Next, I want you to think about tax-free exchange traded funds, tax-free ETFs. So you should consider ETFs for sure, because these instruments, the ETFs, usually have lower costs than mutual funds and offer more flexibility as well. So the tax benefit depends on the types of bonds held by the ETF. Let me give you an example. U.S. government bond ETFs may be free from local and state tax, but they are subject to federal tax. In contrast, municipal bond ETFs are possibly free from federal, state, and local taxes. There are many different ETFs available, and many providers or exchanges offer them. So the best ETFs depend on your age, income level, right, retirement goals, risk, and other factors. So if you have questions or you need more info, I would suggest that you actually contact a tax advisor to determine the best investments for your financial status and eligibility. Number 6, we have 529 Education Fund. So another investment to consider is a 529 education plan if you are thinking about reducing your taxes, your tax liabilities, because this plan, the 529, allows you to set money aside for school tuition and higher education. So contributions are after tax and not deductible, but some accumulated tax is deferred. And besides, distributions for eligible college or higher education costs may be tax-free at the federal level, but only tax-free in some states. So you want to check with your state authorities to know more. So one thing for sure is that before you start a 529, please consider the benefits based on your location and planned usage. So spending money on non-qualified expenses is subject to income tax, plus a penalty on earnings. Money invested in a 529 is not as liquid as other investments without facing those penalties. So you got to really think about, you got to make the right choice here. Nonetheless, though, folks, you can change the beneficiary of a 529 plan if the intended recipient decides not to go to college. So, for example, you can transfer the beneficiary to yourself or to another dependent if desired. Number 7, we have U.S. Series I savings bonds. These bonds offer another investment option, although one that may not be as beneficial as other tax-free investment plans. Why? While exempt from state and local taxes, you will be liable for a federal tax on interest income. However, you or a qualified dependent may be able to pay for some educational expenses tax-free using these bonds, depending on income limits and other restrictions. And Congress constantly changes the restrictions on the U.S. Series I savings bonds, so you really want to double check with a professional to make sure that you are aware of the latest regulations regarding U.S. Series I savings bonds. Number 8, charitable donations. So you can actually save on taxes by donating to your favorite charity. So charitable donations are another method for reducing taxes. So you can gift stocks to a charity in order to pass on capital gains tax. A charitable donation can also provide tax deductions when itemizing your taxes. So you want to research this method carefully as there are restrictions, time limits, and downsides. Nonetheless, in some situations, especially for high income earners, this may be a beneficial methodology. Another option is to gift money to a dependent. You can actually do that. And there is something called the UGMA, so Uniform Gift to Minors Act. The UGMA provides tax-free and lower tax bracket options for certain investments. It is critical to note, though, folks, that these gift amounts have the potential to impact the child's future financial aid eligibility. So there are also complicated gift tax laws to consider. So while this approach may not be as tax efficient as other methods that I've been talking to you about, it bears further scrutiny. If you need to have more information, I would suggest that you hire you talk to an enrolled agent, or a certified public accountant, a CPA, or a tax specialist, or an estate lawyer, someone who understands the intricacies of taxes and when it comes to estate planning or philanthropic donation. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I want to talk to you. I want to continue the conversation about the top 10 tax-advantaged investments everybody needs to consider. Number 9, we have 1031 exchange. 1031 exchanges are a form of tax-free investing which involve changing an investment without paying on the capital gains. So the approach is very simple. You see this a lot in real estate, where one property investment is replaced by another and gains are reinvested. So the capital gains tax may be deferred to later dates, as there are no limits on the number of 1031 exchanges that can be made. However, there are limitations on which investments can be exchanged, and there are also taxes, and you need to know this. There are also taxes due for amount differences between investments. So since there are many complications that can arise from this method, it is highly recommended that you seek expert financial advice before reinvesting. Very, very important. Number 10, last but not the least, we have indexed universal life insurance. So one of the most flexible tax-free retirement strategies that we have researched is the indexed IUL, indexed universal life insurance. So when properly structured, IULs allow you to accumulate a cash value within any life insurance policy. So very important to understand that you are able to accumulate a cash value within a life insurance policy. So tax-free loans can be taken throughout the life of the policy and repaid only if desired. And IULs can help supplement employer-sponsored retirement plans or IRAs, or make a great alternative for small business owners who cannot contribute to a plan for employees. There are no funding limits here. That's what we love about this account, this plan. There are no withdrawal requirements, or there are no restrictions like a traditional retirement account. So this plan does not only benefit high income earners like some of the other options that I've talked to you about, and it can be set up at any age. For example, let's say you're a parent. You can own a policy on a minor child, which can provide a college funding option or future financial security for the child. So I want you to remember, though, that to take advantage of these benefits, the IUL must be structured correctly. So this is something you need to think about. You want to reach out to the right company before you make any decision. All right, folks, this is it for today. I really appreciate your attention. I was talking to you about the top 10 tax-advantaged investments everybody needs to consider. Number 1, 401k, 403b, employer-sponsored retirement accounts. Number 2, traditional IRA, Roth IRA. Number 3, health savings accounts, HSA. Number 4, municipal bonds. Number 5, tax-free exchange traded funds. Number 6, 529 education fund. Number 7, U.S. Series I savings bond. Number 8, charitable donations. Number 9, 1031 exchanges. And number 10, indexed universal life insurance. Thank you so much for your attention. Again, I really appreciate it. I will see you next time. But until then, remember, stay marvelous.